Good afternoon, everybody, and welcome to today's top 10 stock picks preview. You got John Hopkins here, Tom Bowley going to be joining us in just a minute. If you're new to Earnings Beats, want to welcome you. Appreciate you taking the time to stop by. Of course, for those of you who've been with us, some of you for many, many years, since we first formed back in 2004, welcome. Want to let everybody know tonight's event will be recorded. In the event you are unable to stick around for the whole thing, you'll be able to watch at your leisure. Tonight's event is actually a sneak preview that's open to all members of our community, including those who get the Earnings Beats Digest, those who are subscribing members. And it's a preview for an event that will come up Thursday, which is when Tom will actually unveil 40 stocks, 10 stocks in each of the 4 portfolios that he'll be going over tonight. So if you're a member, you don't have to do anything. As usual, you'll get the room instructions prior to the event. But if you like what you see tonight, you can actually join as a trial member for zero cost. Go to our website and you'll see that you can sign up for free. And you'll be invited as well. So hopefully you'll be able to join us. It's one of the most popular events we have. We have 4 of them a year, and they're all highly attended. Also, tomorrow night is our Max Payne option webinar. Always fascinating stuff. I can't wait till tomorrow because I know Tom predicted's the wrong word. Tom laid out the case for a few stocks that could move higher or lower into options expiration last month, a few days prior to expiration, that I think turned out pretty well, as I recall. So this is a great event for those of you who are interested in getting a sense of where certain stocks in the indexes might finish between tomorrow and options expiration monthly on Friday. That's a members only as well, but you can attend even as a trial member. I know Tom's got a lot to cover. People have a lot to do. So I'm going to go ahead and see if he's around. Hey, Tom.
Hey, how's it going, John? Hello, are you there?
Yep, I'm here.
Yeah, I was saying, how are you doing?
Second, good. I was saying I really love this preview page that Aaron put together, and I particularly like it because that's put a few years on since that picture, but I'm just going to leave it for now.
Yeah, I would leave it if I were for you.
Okay.
Yeah, I'd leave mine too.
Leave them both. Anyways, how was your weekend?
Weekend was not bad, a little busy, trying to get caught up. So
Yeah.
this time of year or this time of the quarter is really tough just because there's so many earnings coming out, and try to get those earnings, our different chart lists, try to keep them up to date as best as possible. But I tell you that this year, this quarter, they all just kind of hit at once, and I had some traveling to do last weekend, and it was and my car broke down, so it's a little combination. So it was
Mustang broke down.
Yeah, I was going back for a family. One of my uncles and aunts, we were celebrating their 63rd wedding anniversary, and I hadn't seen them in a while, and I know my uncle wasn't doing particularly well, so I wanted to get back for that. So that was about a 8 or 9 hour trip each way last weekend, and then broke down on the way.
Oh, Jesus God. Oh, of course. Speaking of cars, I'm in Michigan for this week. I drove here. That was a 1.5-day drive. And I'm going to let you get on with the webinar, but just real quickly, this for anybody who's sort of a car buff or interested in cars, every year Detroit has what they call the Woodward Dream Cruise. And it's a bunch of people reliving the old muscle cars, back in the 60s and 70s. And you get about 40,000 cars participating in this parade and about 1 million people on the sidelines watching it. So So it's like a fascinating event. I like, I got Detroit in my blood, so I have to be here.
Yeah. Sounds like a fun event.
Yeah, absolutely. Okay, listen, I know you got a lot to cover, so take it away.
All right, sounds good. First, welcome everybody. Yeah, this is one of my favorite events because I usually take the time, in addition to beginning of the year and middle of the year, when we do market updates, I like to take a look a little bit at what's going on in the market, and try to give you a little idea from my perspective anyway, some of the things that I'm looking at in the market. And so the sneak preview gives me an opportunity to talk a little bit, not just to our members who have been with us for a long time in many cases, but also to a lot of you who maybe are new to earnings beats. And so it's an opportunity for me to go over our approach and our style and the way that we strategize to put together these portfolios, which have a really nice long-term track record relative to the benchmark S&P 500, which is our goal. Our goal was to actually beat the S&P 500. So, and a lot of times our portfolios are put together in a way that maybe the S&P isn't the best benchmark. Maybe it might be the small cap. Maybe it's growth, because many of our stocks tend to be on the growth side. There's a lot of different ways, but generally I just like to use the S&P 500 as the benchmark because ultimately over time, that's really what we strive to outperform. Going to go through the agenda with you today. We've got a few things want to go through. First, the introduction, obviously welcome. Appreciate everybody stopping by. I will try to keep this to an hour. There's a lot of information, a lot of charts I'm going to go over. So it may run a little bit long. As John mentioned, all of our events are recorded. This is no exception. So if you do have to leave for some reason, we'll make sure that we get copies out to both our members and to the Earnings Beats Digest community. So we'll make sure that you get a copy if for any reason you need to leave at a certain time. Going to get into the portfolio results a little bit. Obviously, they don't finalize until Thursday's close. That's when the 3-month period ends. And then we will select, as John also mentioned earlier, the 10 new stocks for each portfolio. They're equal weighted. And we hold all 10 stocks in each portfolio for 90 days or for 3 months. So those that go in the portfolio on August 19th will come out on November 19th, and we'll do this all again. We've been doing this now for quite a while. Our flagship model portfolio started in November of 2018, and then we added the income portfolio and the aggressive portfolio in May of 2019, and then the strong AD or the strong accumulation distribution portfolio was added May 19th of 2020. So got a little bit of a track record now behind us. In terms of the portfolio results, the model portfolio now is up roughly about 225%, I believe. And the S&P 500 over the same time period is up about 66%. I may be off a percentage or two, but again, long-term track record, I think, has been very strong. And that's our flagship. The other portfolios, 2 of them are above the S&P 500. One, our income portfolio, is below the S&P 500. But overall, I think our performance has been pretty strong. We'll talk a little bit more about that in just a minute. Awareness factors. This is just where I want to get into and talk a little bit about what's going on in the market. So in putting together a portfolio, what are some of the things that maybe are changing in the process of changing that could influence how we want to put things together in the portfolio? So it's just being aware of our environment, what's taking place in the market. Then I want to talk a little bit about key chart lists, because we do keep multiple chart lists for our members. These is what I refer to as our research platform. We do a ton of research, and we organize all that research in chart lists at Stock Charts. So if you're a Stock Charts member, it's very easy. You just download our chart lists into your account, assuming that you're at least an extra member. And if you're not a Stock Charts member, we do have an Excel download of the symbols so that you can then just download those into whatever program you use if it's not Stock Charts. So got a lot of that, but I want to go over a couple of the chart lists that really are important that you need to be aware of in terms of us strategizing to do these portfolios. And then talk a little bit about portfolio strategy changes or things that we're considering for Thursday. And then we'll round it up, talk a little bit about the draft that we will have on Thursday, August 19th. All right, so first, I do want to just take you over to earnings beats for one quick second. Always have for these events, and we've got another this week. And just to make you aware that if earnings beats and you want to try, as John mentioned, you can just you go to earningsbeat.com, and then right here at the top you can click on this trial. You can get your trial started, no cost whatsoever. And if you decide you like it over the next couple of days, we'll be running a special, our webinar special, which we like to have out there for anyone who takes the time to come and check out what we're doing. But the regular monthly rate, if you sign up for a 30-day trial and you don't do anything, you just let it roll into the monthly rate, it's going to be $147 a month. But we have an annual special that we run from time to time, and if you sign up as part of one of these events, we give you a bonus month. So you get 13 months for the price of 12, and the annual cost is $997. So $997, you divide it by 13 months, you're talking about a huge savings, probably close to 50% off of that regular monthly rate. So just want to make sure everybody's aware of that. But first thing, if you haven't tried us, this honestly would be a great time to give us a shot, because we do have the draft coming up. We've got Max Payne webinar, which is a member-only event. That's tomorrow night. So this would be a good time to come in, check us out, and see what you think of the service. And again, don't forget, annual special. If you have any questions, you can write to us. Just write to us at support@earningsbeats.com. And if you're interested in the annual special, we'll make sure that you get information on that and we'll get you set up. All right, let's move on, and got a lot to go over. So, as far as portfolio results, I thought this might be an interesting way to talk a little bit about what has happened here over the course of the last year, because it's been a lot going on with the market over the last year. I mean, obviously we're coming out of a pandemic, but the rotation that's taken place has been kind of crazy. And what I've done on this particular chart is I show you the candlesticks that you see in here that keep going up all the way up over here. That's the S&P 500. And then I've got three lines in here. One, the dark blue line, is our model portfolio. So you can see our model portfolio has been doing pretty well. Actually pulled back here in since February of 2021. It especially had a rough quarter from February 19th through May 19th. And that's, you can see between these red dotted vertical lines, that's the period from February 19th to May 19th. And you can see the blue line here goes, it's pretty rough over that quarter, because we were still heavily involved in the growth stocks, and growth stocks did not perform well at all during that quarter. Since then, when we had the event in May to talk about and when we had the draft, we pointed out that, hey, we're still feeling very bullish about the overall market, but there's some question as to whether or not we want to be in growth or value. So what we did is we simply went into both, and we kind of split it in our portfolios. And at the time, I felt like, hey, we're going to go higher. I felt like we would go higher in the S&P 500. And what I didn't want to do was have another huge down quarter, because growth was underperforming. So we split it, and it helped in a way. I mean, we were trying to keep up with the S&P 500. At this point, we're probably underperforming by a couple percentage points on the model portfolio. I think our aggressive is higher, and our strong AD and income are definitely lower. But the model portfolio, if you take a look at it, has been a little bit more stable, and it's been rising. So that's been a good thing for us. We're participating in the move to the upside, and that's what we talked about back in May. We weren't trying to hit a home run. We were just trying to hit a few singles over this last quarter. We wanted to be a little bit more cautious, didn't want to get caught in one area or the other, where all of a sudden the market makes a big reversal, and then we get caught for 90 days in the wrong area of the market. So it was a strategic move. to simply try to be a little bit more cautious and spread our risk around different areas of the market. These other two lines that I have on here, I thought were worth showing. One of them is the Ark Innovation ETF. If you're familiar with Cathie Wood, she obviously was in the news quite a bit with her Ark funds and the fact that she had done so well back in 2019, 2020. Well, her philosophy is based on growth, future growth. And so I thought, when we put the model portfolio on here against the S&P 500, probably would be a good idea to show what some of these other growth, these widely invested in growth ETFs are doing. So one is in the green here is the Ark Innovation ETF. And then this red line that you see here is the Innovator IBD. So that's Investor Business Daily. That's their IBD 50 fund, which is also, it's a momentum fund, a lot of growth stocks and so forth. And what I wanted to point out in here is actually, all of the three growth funds really were all over the place, February through May, mostly to the downside. And we held up better than the other two, which I was happy about. But still, we had a really rough period versus the S&P 500. Now, we had climbed a lot above the S&P going into February, but we ended up giving a lot of it back in that last quarter. So we made the strategic change in this past quarter from May 19th through now to spread things around a little bit, not go completely momentum and growth, but also to kind of mix it up with some value stocks and stocks that maybe were not nearly as volatile. And I think it paid some dividends because we've been more stable, especially if you consider where the IBD has gone. That's the red line. You can see this huge drop here and then big rally. Or the Ark Innovation had a big run back to the upside in this ARKK. But then look at what's happened here over the last 6-7 weeks. It's been rolling back over while we've actually held on to value. So I think, our strategy for this last quarter, even though it was a little bit more cautious, I think was probably the right one based on how the markets performed. As I mentioned, the model portfolio is under the S&P 500 by a little bit, but I'm okay with that. This was a quarter where we wanted to be a little bit more cautious, and I think we did that. And so just wanted to point out how this performance, even though we're underperforming, we're still trying to keep that growth flavor, but at the same time, trying to be a little bit more cautious so that we don't get caught like we did from February to May with all that volatility and underperformance. So I think overall performance has been maybe a little less than the S&P 500, but still 3 of our 4 portfolios are higher this quarter. And actually, I think the income might be higher, might be getting close to going positive. But it's pretty much just been flat for the quarter. But the other 3 have been rising. So we are participating in the move, and the aggressive has actually outperformed the S&P. So that's been one real positive for us this last quarter. But of course, in investing, you're only as good as your last quarter. So we're looking forward to the next quarter in hopes of beating the S&P 500. All right. Another chart that I wanted to get into here. This was the model portfolio versus the S&P 500. So the top panel is how our model portfolio, since we started all the way back here in November of 2018, how we've performed versus the S&P 500. So when you look at this quarter, February through May, it was not a good quarter at all. And even here over the last 3 months, just going along for the ride. We went up for a little bit, then we went down. Now we're trying to rebound a little bit against the S&P, but we're down a little bit this quarter, not much. But again, we're trying to avoid that big drop that we saw last quarter. But look at what happened prior to that. I mean, sometimes some things kind of get lost in the, in the shuffle here, but you've got model portfolio outperforming the S&P 500 by a huge margin from March of 2020 during the pandemic all the way through February. So that 1 year period, while the S&P went down and then came roaring back, we, for the most part, outperformed the entire year. A little bit of down, ticks to the downside, but we came roaring back each time. This quarter was different simply because money left growth. Down here on the bottom, I'll kind of show you what happened. And that's the other thing that we like to do when we're talking about these portfolios is I go through and I talk about the things that I'm expecting and what I'm looking for. And I also point out some of the things that, hey, if this happens, this could go against us. And the reason I do that is so at the end of the quarter, rather than just sit back and say, oh, we beat the S&P or, oh, we fell short of the S&P, we can look back and say why. I mean, it's generally pretty easy to see why. The February to May quarter, you can see right here, the IWF versus the IWD, which is the Russell 1000 Growth ETF versus the Russell 1000 Value ETF, broke this support level. This line right here, this red dotted vertical line, February, this is when we had to select our portfolios. At that point in time, growth stocks had been holding on a relative basis to this relative support level. Literally the day after the portfolio came out, we announced our 10 stocks in each portfolio. The very next day, it broke down. And so we had 3 months of basically growth stocks in an environment that was shunning growth. And that was not fun. Now, in the last 3 months, you can see growth definitely has returned, but as a result, we wanted to be a little bit more cautious. We spread things around. We did okay on some of the value stocks. We did okay on some of the growth stocks, had some winners, had some losers. And you can see overall, we tried to get rid of a lot of that volatility. And I think we were fairly successful in that. But as we go forward, I'm still a believer in growth stocks. And we'll talk a little bit about strategy changes in just a bit, so I won't get into that now. But I did want to just kind of point out what had happened for those of you who may be new to earnings beats. This is, you want to look at the various themes in the market and then make your calls based on those themes. But at the end of the day, if the themes don't work out, then it doesn't really matter what kind of strategy you're putting together. I mean, if your overall theme breaks down, as this one did, then it's going to be a little bit tough on your performance for that particular quarter. All right, let's move on. I want to talk a little bit about awareness now. And the first thing I want to talk about is the secular bull market that we are in. And, we get so caught up in the day-to-day in the stock market, the week-to-week, and the news stories, and, the overbought, the oversold, the negative divergences, the shifting and the rotation, and, defense leading and then offense leading. And it's so easy to get confused and to have in your emotions get control of, your trading or your investing. I just want you to kind of take a step back and look at this chart, because this is kind of the guiding light for me in the stock market. The S&P 500 has a history of going through these various cycles. You'll go through secular bear markets, then you go through secular bull markets, and then you rinse and repeat. And if you look back over the last almost 100 years, we've had 3 secular bear markets and 2 complete secular bull markets. And I think we're in the 3rd one right now. That's over 90 years. 3 bear markets, and we're in our 3rd bull market. That's kind of important, but kind of strange at the same time, because you think, oh, you go into bear markets, bull markets all the time. Well, these long-term or secular bull markets and bear markets tend to last quite a while. Now, you can have cyclical bull markets and cyclical bear markets within these various secular markets, and those are more short-term in nature. And I just want to kind of point out some of these. So when you look at the market from a big picture, you can see from year 2000 to 2013, the S&P 500 went nowhere. From this high in 2000 until we finally broke out on April 10th of 2013, we could not put in a new high. If you look back 1969 to 1981, again, right about a 12-year period. This one's 13 years, or a little, maybe 12 and change. This is probably right around that 12-year mark. Go back to this one. This was obviously a lot longer, dating back, in the 1930s and 40s. But I actually look at it as the breakout right here in 50, leading to about a 19-year secular bull market. The breakout in 1980, 81 led to 2 decades of strength, the 80s and 90s. And now, after going sideways for 12 or 13 years, I believe we're in a secular bull market, and we're probably only in about the 3rd or 4th inning. I think we're going a lot higher. I think the S&P 500 will probably triple from here by the time this ends. Now, does it mean it's going to go up every day? Well, the market seems to be telling us that's what it wants to do right now, but no, it's not going to go up every day. We're going to have some rough periods from time to time. I circled this right here. This was 1987. In the midst of a great secular bull market, we had that 1987 market crash. In the midst of this current secular bull market, we had the 2020 pandemic, which we're now looking back on, kind of like we looked back on 1987. Notice when we had that big crash in 87, we took off. We never went anywhere near that low again. That was a pretty significant low. I think we're going to look back 10 years and we're going to see the same thing from the 2020 low. I don't think we'll ever see that number again. 2120 or 2191 on the S&P 500. Don't think so. And in the midst of this, back on March 13th, I wrote a Chart Watchers article and I said, in my opinion, my belief is we're still in a secular bull market. It may have looked crazy at the time, but look at what we've done since then. Gone right back up. The market, secular bull market, is very, very resilient. So if we're trying to figure out, okay, how are we going to set up these portfolios? Well, first off, we're in a secular bull market. Doesn't mean we can't go down and we can't have cyclical bear markets. We do have those from time to time. And I'm going to show you what a couple of them look like here in just a minute. But when you look back, we had a cyclical bear market with the pandemic. We had a cyclical bear market in the 4th quarter of 2018. We lost 20%. Can't really see it. It's like a little blip on the radar there. We lost 20%. In this secular bull market, not only did we have the 1987 crash, in 1990, we had a drop of more than 20% in just a few months. Can't really see it on the chart, because it just looks like a little blip. This 1950 to 1969, these 19 years, you may not remember it. I was only 1 year old at the time, so I certainly don't remember it. But 1962, I think they referred to it as the flash crash of 1962 or the Kennedy slide. But we dropped over 20% in 1962 in the midst of this secular bull market. So it happens. We're going to have periods where we pull back, but we can't go every single day fearing one of those pullbacks. And I feel like that's the way most everyone approaches the stock market, always looking for that top in a market that really just wants to go higher. We're always trying to figure out where that top's going to be because there's so much wrong with the world. Yet the market, very resilient, just keeps going higher. Let me show you some of these periods because it's going to happen. We could get one. We could get one now. We could get one in 2022. I don't know when we're going to get one. We got to kind of keep our radar up and see. But let me show you some charts that I think you'll find interesting. Here's 1962. From December of 1961 through June of 1962, we lost almost 30% in the midst of that 20-year secular bull market. This was pretty scary. Kind of hard to believe the S&P 500 was at 72 back in 1961, but it was at 72. It dropped from 72 to 51 in 6 months, 7 months. All right. How about 1987? Here was the crash. There's August of 1987. Here's October, almost even December. We almost got down to have a retest. Not quite. But we lost 36% here in just a couple of months. 36%. More than 1/3 of the entire value of the stock market gone in 60 days. I mean, that's unusual to see that kind of a drop to that extent, 36%, but it happens. The pandemic, February to March. I mean, this was literally about 4 weeks, 35.6% down, gone in a very short period of time. Now, I think 1987 and 2020, outside of the crash of 29, I mean, we have not seen too many of these. I would not be going around investing in the market fearing a 35% drop in 2 months. I mean, it just doesn't happen very often. And we just had one. So the chances that we're going to have another one are very slim. I'm not saying it can't happen. Anything can happen in the market, but you shouldn't be approaching the market with that kind of fear. Next up, here's that 1990 cyclical bear market. In the midst of the 80s and 90s, the secular bull market that we had, here was a cyclical bear market. This looks almost identical to what we saw in the fourth quarter of 2018. I'm going to show you that in just a minute. But here was the high, 370. Here's the low, down around 294, 20.4% drop. In how long? 3 months. The difference between a cyclical bear market and a secular bear market is probably about 2.5 years. A secular bear market, when we get into one of those big declines, it can go over 2 or 3 years. These cyclical moves tend to happen in about 2 or 3 months. So the last one I'm going to show you here, this is 2018. Same thing. There's your high, 29.50. Here's your low, 23.50. 20.4%, exactly the same as 1992. Or excuse me, 1990. So history does repeat itself. You go through secular bull markets. You have cyclical bear markets within the secular bull market. And you just have to realize they're going to happen from time to time. That's why, from a long-term perspective, I continue to say, stick with this market. Don't get overwhelmed by the media and all the negativity. There's always something wrong with the market. There's always something wrong with the technicals. We're always overbought. There's not enough breadth. Volume's not high enough. I mean, you listen to it day after day after day, and it wears on you to the point where you truly believe the market can't go higher. The market wants to go higher, and I believe it's going higher. But we will have, and if we have a really strong fourth quarter this year, and we break 5,000 on the S&P 500, would I be surprised next year if we had a 20% cyclical bear market? No, I would not. I think it could happen. I think it could happen in the first quarter of next year as we start to realize that growth is not going to be in 2022 what it was in 2021 because our comparables are going to be different. But I'm not worrying about that right now. I don't want to sit here and try to call the top in the market every 2 weeks. You got plenty of people you can listen to on CNBC for that. I mean, Peter Schiff, how he keeps getting on CNBC, I will never understand. The guy always talks about how he called the top in 2007 and 2000. Well, if you call the top every month for 20 years, guess what? You're going to nail it twice. But yet he still goes, I mean, you listen to him, he's still bearish. Everything, he was bearish 4 years ago. The S&P 500 doubled and he's still bearish. And yet if the market goes down, he's going to claim victory. That's what a lot of folks do when they're bearish, perma bears. Now you might look at me and think I'm perma bull. I'm not a perma bull, but history tells me that I want to be bullish a whole lot more than I'm bearish. So I'm going to stick with what I'm seeing on these charts. And right now we're in a secular bull market. I am not going to try and keep calling tops in a secular bull market. I think that is a waste of time and a waste of a lot of money. It's the opportunity cost. If you think the market's going to go down and you're sitting out and the market keeps going up, it's not that you're losing money. It's just you're not making the money that you should be making. And then when the market does pull back, you don't have all those gains to buffer that pullback. Anyhow, I don't want to keep dwelling on this too long. But my point here is that we are going to have these cyclical bear markets at some point, that we're going to have one show up. September's a horrible month historically for the market, at least relative to the other months. Could we pull back in September? Yes. Will it be a 20% drop? I don't think so. I would be, if the S&P fell 3 or 4 or 5% between now and the end of September, I wouldn't be shocked. But to try to predict something beyond that, the market's so resilient. I just wouldn't want to do that. All right, let's keep moving on. So other awareness factors, got to know what's going on with the dollar. I look at this chart at least once every week or two. This is a chart. The top panel is the U.S. Treasury yield minus the German 10-year Treasury yield. And the whole idea here is, what are our yields doing in the U.S. versus Germany's? I mean, the yield should be telling us a little bit about what's going on in the economy. And so if we look at what our yields are doing versus Germany's, it should give us a pretty good idea of what our economy is doing versus Germany's economy. And so when we're going up from left to right, that tends to mean our economy is stronger. And usually we see the dollar go up. So down here, I've got a correlation between the direction of the difference in yields between our two countries and the US dollar. And the correlation is almost always positive. Almost always positive. I put this line in here at the minus 0.5 area, and I've circled the times that we've seen inverse correlation that goes beyond minus 0.5. It's happened 6 times since 2007. If I drew a line up here at plus 0.50, I mean, you could see we spend a whole lot more time up there. So what's the moral of this story? The moral of the story is that the dollar tends to go in the direction of the difference in yields between our two countries. I want you to look at what's going on right now in the 10-year Treasury yield here in the US versus Germany. We are rising again. Yes, we broke down for a while. Yes, the dollar went down. The dollar had broken its trend line. The yields were coming down, but that has changed. We held on to key price support on the dollar index down around 88, 89. You can see multiple tops here back in 2008, and then again 2009, 2010. These tops all came in just above 88. When we finally broke through in late 2014, when we went back down, we held. Here we've gone down. We got a double bottom in around 90. We haven't broken down. Now, if the dollar goes down and breaks below 88, we got a different ball game, and then we'll have to reevaluate. But right now, what I'm seeing is U.S. yields going up versus Germany, which normally leads to a rising dollar. And that's what these shaded areas are identifying. So here you can see the U.S. Treasury yields were going up faster than Germany, but the dollar was going down, and that resulted in inverse correlation. What happened after that? The dollar soared. You move forward 2013, 2014, same thing. You got the yields going up faster in the US, the dollar was going down. We had this inverse correlation. What happened? The dollar soared. Here, to a lesser degree, same thing, yields rising in the US faster, dollar going down, inverse correlation, dollar soars. Now, move on to this red shaded area, it was the opposite. So here we saw the yield going down, but the dollar actually was still going up, putting in a high at the end of this period. So we had these inverse correlation readings here. What happened? The dollar collapsed. Notice it's always the dollar that's playing catch up here. Now what do we have? We have the 10-year Treasury yield in the US going up versus Germany. Not exactly going down, but we're not going up either on the dollar. And as a result, we're starting to move into this inverse area again. We're not there yet. But what this is telling me is that I should be expecting the dollar to break out. Why is this important? So what happens if the dollar breaks out? Why does that even matter? Well, it matters because if you're putting together a portfolio and the dollar is rising, you need to realize that energy on a relative basis goes down when the dollar is going up. Materials on a relative basis goes down versus the S&P 500 when the dollar is going up. When the dollar is going down, like it was back in 2002 to 2008, Energy led to the upside on a relative basis. Materials led to the upside on a relative basis. So the dollar matters in terms of where you want to put your money. Do you want to be in energy and material stocks? I think a lot of it depends on what you think of the dollar. Now, you might argue, hey, the dollar's been going down. It's in a little bit of a bear flag, and therefore it's probably going to break down. But based on the chart I just showed you, I would argue that that's not the case, that U.S. Treasury yields are moving up. And if anything, history tells us the dollar should break to the upside. So if the dollar moves up, and I'm going to be watching this, but if the dollar moves up and gets back through that 93 level and takes out that double top, I don't want to be in materials and energy. And that doesn't mean every energy and material stock's going to go down. There are probably still going to be plenty that do well, but there are going to be headwinds, and trying to find a winner when the overall groups are underperforming the S&P 500 is going to be much more difficult. So one theme I can tell you, or at least one of the things I'm aware of going into this draft, is that energy and materials, which have been we had them as part of our portfolios the last quarter. Not sure we're going to have them in there next quarter based on what I'm seeing right now. So I think that's important. Next up, this is one of my favorite charts to evaluate the overall strength of the bull market. The XLY versus the XLP, consumer discretionary versus consumer staples. Consumer discretionary is an aggressive area of the market. When the economy is strengthening, consumer discretionary stocks should do well. When the economy is strengthening, consumer staple stocks should do okay, but they're not going to do as well as consumer discretionary. Let me give you an example if you're not familiar with the two sectors. Starbucks is part of consumer discretionary, one of my favorite places. I go there, I work every day, I always get my latte. But if the economy is strong and you feel good about things and you feel good about the economy and so forth, the stock market's doing well and your retirement's up, you don't mind going to Starbucks and spending that extra $1 or $2 for your latte over, where you might get it somewhere else. And it's not just Starbucks, it's anything. It's needing a new home. If you feel good about things, you'll go out and you buy a new home. Well, home construction is part of consumer discretionary. If you feel good about things, you might want to replace the car you've had for the last 5-6 years. Automobiles, that's part of consumer discretionary. But if the economy is strong, when was the last time you went out to buy soap and said, you know what? I think I'm going to double up on soap this time because the economy's been so strong. I think I'm just going to bathe a little bit more. I mean, that's not happening. Consumer staples are the companies that produce the things that we need, not the things that we want. We're going to get consumer staples products, whether our retirement account's going up or not. We're still going to need soap. We're still going to need toothpaste. We're still going to need all those things that we always need, regardless of what the economy is doing. We may not go out and get that new car, but I sure hope you go and get your toothpaste and your deodorant, your soap. So when you're looking at this ratio, and I very definitely oversimplified things there a little bit, but if you just pay attention to what the market is telling you, when consumer discretionary stocks are outperforming, Wall Street is typically expecting our economy to be strong. And remember, the stock market's always looking ahead. It's not looking at what just happened last year. It's looking at what it believes is going to happen later this year and into next year. That's how the stock market gets priced. So when the XLY versus XLP is in an uptrend and breaking out, that is generally a very, very good sign that the stock market strength is sustainable. So when you look at the S&P 500 and you see it going up and you see consumer discretionary on a relative basis breaking out versus staples, it should give you some pretty good warm and fuzzies about the market. And if you need some proof, look at the correlation. So the correlation down here is essentially giving us some idea of the direction of the XLY versus the XLP and how it correlates to the direction of the S&P 500. So anything above 0.5, and especially if you get up near 1, that's telling you that the ratio and the S&P 500 are going hand in hand. And if you go down here below minus 0.5, or you get to minus 1, it means the ratio is going in opposite directions with the S&P 500. Well, if you notice, if you go back the last 10 years, we've had 0 readings below minus 0.5. You will see occasionally a little bit of inverse correlation, but for the most part, this is a positive correlation. So when you've got the market going up and you've got consumer discretionary outperforming and remaining in an uptrend, that is a sign to me that the stock market advance is sustainable. And we're in a secular bull market. So that's exactly what, that's exactly the reason why I want to make sure we're in this market. Now, does this mean that the stock market can't have a cyclical bear market? No, it does not. We've had plenty of bullish signs before, and yet still fell apart. I mean, it's kind of hard to really talk much about the pandemic because, that was a virus that had nothing to do with a cycle, an economic cycle. It didn't predict any kind of a recession. I mean, we ended up having one only because we had to shut everything down because of the healthcare crisis. I think most of us probably can agree that that was maybe a once in a lifetime kind of a thing that the stock market had to deal with. So if you eliminate that little 1 month period, I mean, for the most part, you're just looking at constantly moving up, consolidating, moving up, consolidating, moving up, consolidating. That's what we're doing on this relative chart. I think that's really important. All right. Another thing you want to focus on, copper versus gold. Copper is the commodity that's used in construction. And so when the economy is strengthening, you're going to need to buy more and more copper. Gold, on the other hand, I mean, when was the last time you've seen a whole lot of gold being used in construction? Not really. Gold is more of a hedge against inflation. It's a hedge against weak market. It's a hedge against volatility. It's a hedge against fear. It's all of those things. So if you look at copper and follow copper versus gold, I want you to take a look at this chart. When copper is in an uptrend versus gold, like it was here in 2016 through 2017, or like it was 2011 through the end of 2013, or like it is now, look down here at what happens with the S&P 500. During this 2-year period, a little over 2 years, the S&P went up 64% when copper was outperforming. When copper was underperforming, this is over about 2.5 years. I don't know. We might have gone up 10%, maybe. Didn't measure it, but not a whole lot. Then the next 1.5 years, when we moved up, S&P another 27.4% higher. Then once again, copper versus gold's in a downtrend. What did we end up doing? A lot of volatility, but from start of the period to the end of the period, we went nowhere for 2.5 years. Now, during this period of strength in copper versus gold, the S&P is up 61%. Copper, when it's strong against gold, is giving us a signal about the global economy. And when the global economy is strengthening and that demand for copper is going up, that is generally a very, very strong signal for the S&P 500. Once again, look down here at the bottom. Correlation tells us just about everything we need to know. These are important signals to watch. Forget about CNBC. Just forget about it. I mean, they have some really good guests from time to time, but for the most part, they're trying to sell ads. They want fear. They want the things that sell, that will create interest so people will tune in and watch their ads. That's where they get their money. There might be there may be some secondary importance to educate everyone, but it's secondary, trust me. Primary is making money. And they make money by getting more people to view and more money from advertisers. Next up. Well, I mean, we can go through these sectors here. Essentially, you got to be aware of what's going on in the various sectors. So technology versus the S&P 500. When we make these breakouts, you see this prior top in 2007, we broke out here. Look at the strength in technology. Then we went through a period, consolidation. We break out. Look at the strength in technology. This was a little bit briefer period, maybe 6 to 9 months, but we break out and look what happens. Now we've been consolidating in this period almost a year now without a breakout. Watch for this breakout. If technology breaks out versus the S&P 500 in a secular bull market, you want to be aware of it, because normally it's not a head fake. Consumer discretionary. This is a pretty interesting chart to me because we are back down at a pretty key breakout level. This, when you go through resistance, relative resistance, that should provide you some relative support. And we're sitting almost right on it within consumer discretionary right now. So this is a group that has been going up relative to the S&P throughout the secular bull market, which started April of 2013 right here. So consumer discretionary clearly is an area that you generally want to be in. And the fact that we've been down now for about 8 months relative to the S&P tells me this might not be a bad time to maybe take a little bit more risk in consumer discretionary as we go into this next upcoming draft. Communication services continuing to be strong, relative, not as much back and forth, more periods of consolidation. Then we go up, consolidate, go up, consolidate. That's kind of been the history here, but we are seeing outperformance. Industrials, not as much outperformance. I mean, this is obviously much more impacted by our economy and cycles that we go through, shorter term cycles. And so when we had the pandemic, obviously, manufacturing was grinding to a halt. Supply was cut off, and now we're starting now to pick up again in manufacturing. And so we've seen industrials pick back up again from those lows, but that was a steep, steep drop in industrials. Same goes for financials. Financials, we want financials to at least kind of go along for the ride. Normally when financials are not doing well, the market struggles. And so when we had that first big drop, March into early April, that's where most of the weakness came in financials, and that's where most of the stock market weakness was. Since then, we've kind of leveled off, and then we've started to strengthen as yields have moved back up again. So financials, I don't need financials to be the major leader. And again, if you look at where we are now versus where we were in 2013, when we broke out into the secular bull market, financials haven't really done much. And if we go back to industrials, April 2013, we were here. Industrials really haven't done much. Where you want to be is in technology, consumer discretionary, communication services. Those are the 3 areas in a secular bull market where earnings grow more rapidly. So when you get opportunities, when they pull back and they sell off, you get opportunities to get in. That's generally a pretty good time to do so. All right. One other chart I wanted to show you here was, let me show you the utilities. So I just went through the 5 aggressive groups. We already talked about energy. We talked about materials when we were going over the dollar. So that's 2 sectors. So that's 7. The other 4 defensive groups. Look at utilities, where we are now versus where we were in 2013 and April 2013. I mean, yeah, we've had some periods of up, but for the most part, we underperform in utilities. Same goes for staples. Here's where we were in April 2013. Here's where we are now. Multi-year low, a decade low in terms of relative strength. This should also be giving you some confidence about the market, because it's not like Wall Street is pouring into defensive areas of the market. Real estate has done better this year, but look at where we were back in April of 2013. We're way below. Hopefully, as you look through and look at these, next I'll pull up healthcare. Whoops. As you look through these, you'll see what happens in secular bull markets. Now, healthcare did really well first couple years, but we've just been going sideways. Very important support level down here, though, that we just got close to testing in April, and now we're starting to bounce again. So right now, healthcare looks pretty good. There are areas of healthcare that I would suggest are aggressive. Biotechs are definitely aggressive. I would even say maybe medical equipment. Where you're looking at more defensive, you're probably looking at pharmas, and maybe to a lesser degree, healthcare providers and medical supplies. But so there's a little bit of a mixture. So that's why I think you see a little bit more outperformance here. But hopefully just by looking at those sector charts, you can kind of get the pecking order of where you want to overweight for the most part. There's a reason why our model portfolio is up 225% and the S&P is up 66%. It's because we know where we want to be in a secular bull market. And we set our portfolios up in that manner. Now, granted, yes, that February to May quarter, we had a horrible quarter. Growth stocks broke down literally the day after we started the portfolio, and it was a rough month. So right now, we're being a little bit more cautious. We'll see what happens on Thursday, but I expect to be a little bit more aggressive. I don't think we'll get to the point we were in 2020, where we had just a tremendous number of growth stocks in our portfolios. We crushed the S&P 500. I don't see that, but we'll go with leading stocks and leading industry groups as we always have, but we're going to be looking more towards some of those growth areas. All right. Let's move on to key chart lists. This isn't going to take long. We're getting close to the end here. Key chart lists. First thing I want to pull up is our strong earnings chart list. If you're new to earnings beats, we keep a chart list. And if you look here, edit, and you just pull up in the list in edit form, we have 624 companies right now on our strong earnings chart list. What these companies represent is over the last 3 months, these are companies that have beaten top line estimates, beaten bottom line estimates, no exceptions, meaning they've beaten Wall Street's revenue estimates and Wall Street's earnings per share estimates. If you don't beat both of those estimates in your latest quarter, you cannot get on this list. Now, in addition to that, we go through and we make sure that these stocks are liquid. We don't want our members trading stocks that trade 1,200 shares a day. You'll be the entire market when you go to place a trade. And we want to make sure that there's something that we like technically. Either it's part of a strong technical group, or that particular stock is a strong stock. But you can see all of these stocks, and what you can do once you have this chart list in your account at Stock Charts, or if you take our Excel spreadsheet with all the ticker symbols and load it into whatever platform you use. I like the Stock Chart system because then I can pull up this summary form and I can literally look every day at the best performers, and I can hit this percentage change column and I can go back and look at what didn't work. And sometimes by looking at what didn't work, you can find some really good stocks and they're just pulling back. So on these, I might look, for instance, at some of these that have scooter scores, Stock Chart's technical rank. This is a relative strength measure above, say, 95. So you can see here's a stock that's got 99.7, one of the strongest stocks on a relative basis out there right now. And it went down 9% today. Maybe that's an opportunity. Here's another one down here, FULC, 99.4, down 5% today. Maybe that's an opportunity. ERJ, of course, it's in aerospace, which has not been a great group, but it is in industrials, which I think are starting to strengthen again. 97.3. The other thing you can do is once you've sorted it by percentage here, you can sort it by sector. So we can go and we can look for industrials. And just scrolling down till we get to them. And here we go. Once we get to industrials, we can see which industrials did well today. And as we go all the way down, we might find some industrials that did not perform well. There's that ERJ. So it just gives you an opportunity to find some candidates that you might be able to trade. Now, the reason I'm bringing this up is that 3 of our 4 portfolios, our model portfolio, our income portfolio, and our aggressive portfolio, a stock cannot go on any of those portfolios unless they're in the strong earnings chart list. So I'm only going to pick stocks that have beat Wall Street's estimates in the last quarter, as to both revenues and earnings per share. So I think that's one thing that's really important to note. Now, the other portfolio is the Strong AD portfolio, or the Strong Accumulation Distribution portfolio, and that's based on the AD lines. Well, we also have a chart list, which I just updated over the weekend, Strong AD chart list, which then gives us all the stocks in here. They have to meet basically 3 criteria. Number 1, liquidity. They have to be, again, they have to trade probably on average a couple 100,000 shares a day. That's number 1. Number 2, they have to have decent relative strength. I make sure that the scooter score, Stock Charts Technical rank, is at least 80. And then thirdly, most importantly, their AD line, strong AD, has to be a strong AD line. So as we pull these up, let's take a look at a couple of them. So here, actually, the AD line here on this one broke out, but the AD actually moved to about a 6-month high. So that's actually a little weaker than most. Most are going to be very strong. Here's an AD line near its high. Just had a 52-week high at the end of July. This is AutoNation. Look at what happened when it got down to its 20-day. Went right off that 20-day, was up over 5% today. And this is the kind of trade I like, where you get the breakout, the PPO is strong, you pull back, and when you pull back, you hit that 20-day. Normally, you'll get a bounce from there. AutoNation, perfect example. Another one, ANGO. Look at the AD line down here, setting new highs, even though price has not yet pushed to new highs. So that's going to be a stock. It's been in a nice uptrend, so it's a strong relative performer. APTS just broke out, sideways consolidation. AD line is strong, and because it's breaking out, it's going to have a pretty good scooter score. And just one more, AQUA breaking out, and you can see down here the AD line strong. So that's what you can count on from this chart list. So all this research we do, we put into these chart lists for our members, and literally you can download these chart lists. We give you links and a password. All you do, click on the link, and before you click on the link, you copy the password, click on the link, then you paste the password in the spot that it asks for it, and then you just download it into your account. So works like a charm. But anyway, I wanted to bring up those two because all of the any stock that's in the strong AD portfolio, it could come from the strong earnings chart list, but if it doesn't, then it'll be in this one, the strong AD. So that's the only portfolio we have. The strong AD portfolio is the only portfolio we have where you could have a company that did not beat revenue and or earnings expectations, because it could be in there solely because of its strong AD and its strong relative strength. All right, last thing before we talk about the draft, which will be Thursday, portfolio strategy changes. So, and I talked about this really throughout this, so I'm not going to spend but a second here. Overweight industrials is one thing I'm thinking about. Overweighting consumer discretionary is another. When you look at the XLI industrials, and I wrote a Chart Watchers article, you can go in and read that. I'll come back to this. Let me show you the Chart Watchers article. So this is what I put in over the weekend. So here's your XLI industrials, big move up. Here's your rectangular consolidation, sideways action. All right, waiting for this breakout. The PPO is as strong as it's been over the last couple of months. It's now coming up from the center line. This means that we are seeing momentum strengthening. All really since March, we have seen, for the most part, momentum weakening. Now we're above the center line and strengthening for the first time. So if we get a breakout, that would be very bullish. The other thing is, on a relative basis, there's like a little bit of a channel going on here, and we just bounced off of it. So this is an opportunity, I think, for the group to lead. And then finally, if you look at a relative strength, or excuse me, seasonality over the last 9 years, remember I showed you 2013 is when we broke out on the S&P 500, broke into the secular bull market. Well, if you look at this seasonality from 2013 to 2021, and you look at the XLI versus the S&P 500, September and November, we've seen industrials outperform the S&P 500 every year since 2013 in those 2 months. And in October, it's been 50-50. And look at the average outperformance. September and November are the two best months. October, you give a little bit back. But if we just look at these next 3 months, industrials have a tendency to outperform. So not only am I looking at the relative strength starting to bounce, looking at this potential breakout, but history tells me that industrials are placed to be. So, again, when we start putting these portfolios together, it's not just this random here, let's pick this stock, let's pick that stock. There are reasons behind why we're going in various directions. Will they work out? No. Sometimes our themes don't work. We clearly showed that back in February to May. We're not perfect. We don't have the perfect system, but we do believe the market's going higher, and we believe our system will work over time to outperform the S&P 500, which is what we want to do. And I mentioned earlier also just the return to growth. Growth stocks, I believe, are going to continue to lead. We are still in an incredibly low interest rate environment. All signs right now that XLY, XLP ratio, the copper versus gold, everything I look at points to a strengthening economy down the road. And if the economy is strengthening, earnings will go up. And the companies that can grow their earnings the fastest in a low interest rate environment are going to be rewarded in time. Are they going to be rewarded every day or every week or every month or every quarter? No. Over time, though, and that's what we have seen, technology, consumer discretionary, communication services in this secular bull market is where we see leadership from. That's where we've got to continue to maintain focus if we want to beat the S&P. Now, if that scares you, makes you nervous, you want to, you're more cautious than that, you can stick with the S&P 500. But if you want to try to beat the S&P 500, the way to do it is to go with the areas that outperform during secular bull markets. And that's, again, what we try to do. All right, so Thursday's our draft. Again, for anyone that is new to earnings beats, I would highly recommend you try us. If you don't like us after 30 days, cancel. You've done no damage whatsoever, at least in terms of fees to us, because you don't pay for anything. We have a completely free 30-day trial. After the 30 days, again, you're going to get hit with a monthly charge of $147. But if you like what you see here over the next few days or even next couple of weeks, when we have these webinars, we tend to have webinar specials where you can sign up for an annual plan, which will significantly reduce your cost, and we'll throw in a bonus month, 13 months for $997, which is roughly half of that monthly $147. So, and we do a lot of research for you. I think it'll really help in your trading. I think you're going to learn a lot. I view Earnings Beats as a research and education platform. We are not licensed to provide recommendations and advice. That's not what we do. If you decide you want to trade the portfolios, that's on you. It's not on us. We're educating, and sometimes it'll work, sometimes it won't. You've got to be willing to take the risk. We are not registered investment advisors. No one here on staff is a registered investment advisor. So you want to make sure you check with your own personal financial planner or advisor before you get into any stocks or into any trades, because you obviously can lose money. But I think our service is a really strong one. We put a lot of time and effort into what we do, and love to have you try us out as we go into this Thursday event. So Thursday, the event, I believe, will start at 5:30. I can't remember if it's 5 or 5:30, but it'll definitely be later. I don't know if Aaron, if you're listening, or John, 5:30. Okay. Yeah, so it's going to start at 5:30 on Thursday. And the reason that we push them back, because usually we do our events at 4:30. The stock market closes at 4, and there's a lot of work trying to finalize all of our results to present to you when we start the event at 5:30. So from 4 to 5:30, I am going to be crunching some numbers. And quite honestly, I haven't picked any stocks at this point for the portfolios. So all day Thursday is going to be selection process for me. And I may be still selecting even after hours on Thursday based on a stock like I think Applied Materials reports Thursday. I might want to see what their report is. Now, I normally don't pick companies that report after hours because we always take the closing price of the day, of that day. So it'll be Thursday's close. And so it's not really fair to pick Applied Materials and have Thursday's close if they report after hours and they go up. So I would definitely adjust that one and say, hey, we're going to get in as of Friday's open, if that's the case. But some of these bigger companies will be reporting on Thursday, and it's possible I may pick one. Don't know. Anyhow, love to have you. That is going to be a members only event though on Thursday, as is our Max Payne event, which is tomorrow night at 4:30. Would love to have you in there for that as well. That's always a really fun educational event. If you like to trade and your stocks are heavily traded in the options market, you are probably going to want to know some of the information that we share with our members about options. So that's all I had, John. I don't know. Do we have some questions or want to
just
wrap
a
up?
couple. This comes up, pretty much each time we do one of these. It has to do with, are you open to changing the portfolios middle of the 3-month session?
No. And the reason, first of all, we have our chart list. So anybody who wants to trade, we provide a lot of information for folks to trade. What we do with these portfolios, they're not buy and hold, but they're for our members who are interested in not trading every day or not reacting to every time the market goes down or when an area gets rotated out of. And it's not designed to be a trading portfolio. It's designed to be a buy and hold, with the one caveat being it's only 90 days. So we're looking at leading stocks and leading industry groups at the beginning of each of these 90-day periods. We hold them 90 days and then we redo it. And I know, we've had a couple of periods where the market turns on us in the middle of a quarter, but we've had a lot more quarters, to be quite honest, where we've done extremely well. And so, when I look at our model portfolio, for instance, which is up 225% and the S&P is up 66%, why do I want to start trying to change things? Now if all of our portfolios went negative versus the S&P 500, then yeah, obviously something needs to change. We need to stop doing what we're doing. But 3 of our 4 portfolios are still, they still have sizable leads over the S&P 500 over time. So yeah, short term, we're going to get hit from time to time, but I don't know any investing strategy that doesn't get hit from time to time. It's just, you're going to have to, take your hits sometimes, and hopefully you just have more rewarding periods than you do those hits.
Hey, Tom.
Yeah.
So this one doesn't pertain to tonight, but it pertains to tomorrow night, the event, Max Payne. Mm-hmm. And this is a comment from a member. I just have to pass it on. So you can't wait till the Max Payne. I bought a 1K puts or calls on everyone you mentioned since you started it. Some work out awesome, some horrible, but up over 300% since you started it.
Wow. Okay, well, that number one, I would say, is somebody willing to take a lot of risk, because if you're obviously buying puts and calls, unless you're hedging in some fashion, that's pretty risky. But that's, again, we just throw the information out there. Whatever you want to do with it is completely up to you. That's how we operate. We provide the research, we provide the education, and then we let our members, hopefully our members are making better decisions as a result of our work.
Yeah. But it was just something to pass along. Last one, we're going to have to move on. This is a general question, and obviously depends on every person and what their risk tolerance is. But in this secular bull market, should we be 100% invested? That's the question.
I think well, again, I'm not a registered investment advisor, so I can't advise anyone. I can't tell you what you should do. You have to do it yourself. I can only say, based on my experience, that when you're in a secular bull market like this, you want to stay in the market if you're a long-term investor. Now, that doesn't mean that we're not going to have periods of pullbacks and so forth. And as a trader, money rotates. And so as a trader, what you're trying to do is catch momentum. So you might have a semiconductor group that's really hot for 3 weeks. You might get out of it and turn around and then move into another area. Maybe automobiles are starting to move, or maybe it's some area of retail, or maybe it's the defensive groups have taken over, and maybe you want to be a little more cautious than the defensive groups. I mean, that's the whole idea behind having all of these various chart lists and so forth available for our members. Long term, if you just said to me, I'm sitting here, I'm going to retire in 10 years and, I don't really want to trade. Would you be fully invested in the market? Well, I would say this. Number one, it's got to be part of a financial plan. So I don't know how much in your wealth that you want to have invested in the stock market. But if I said, hey, 30% of my wealth is in the stock market, that's what my financial planner has suggested, then yes, I would be fully invested. I would take that 30%. I would be fully invested, whether that's the spider, whether it's the, one of the portfolios, whether it's, whatever you want to trade, your favorite stocks, whatever. I would be invested, but that's just my opinion. I believe the stock market's going higher.
Okay, we're going to wrap it up. I want to let everybody know, Aaron will make sure you all get a copy of the recording. And then tomorrow will be our Max Payne event, with Thursday being the big draft. And hopefully, again, if you're not currently a member, do yourself a favor, take out that free trial, and nothing to lose and just a lot to learn. And that's it from my end, Tom.
All right, sounds good. Again, if you're interested in checking out our service, and especially if you're interested in that annual special, you can write to us at support@earningsbeats.com. And I'm sure Aaron will help get you set up. But that's going to be the best deal that we have, and I think will save you a lot of money. But if you're new to Earnings Beats, I hope you'll give us a try. Come to our event on Thursday and also tomorrow. All of our trial members get the same benefits. The only difference, we have a couple of chart lists that we only give out to annual members just because it takes time. And once you have it, you have it. And so we want to make sure that those who are, we commit to those who commit to us. But other than that, trial members get everything on our platform. So we'd love to have you. All right, I'm going to wrap up. I'll be back tomorrow at Stock Charts TV for the next Trading Places Live. Hope you can join me there. But until then, happy trading.